So the next process I want to look at is the non-current asset, which is your property, plant, and equipment. That's what I'm going to be looking at now. And like I always like you to do, understand the process before you can know what could go wrong, which is the risk, and what controls should you put in place to prevent the risk from crystallizing. Then how would auditors test those controls to be sure that they are being designed effectively and they are also operating effectively, right? So, but PPE is not so much different from the inventory which we've looked at, and likewise, there's also a part of it that you can benefit from your understanding of the purchase to pay cycle. Remember, you will always have to buy PPE, you always have to buy non-current assets. So your controls and risk understanding that you add during the purchase cycle is still very, very important. So what I'll be focusing on here is just those big changes, big difference between PPE and inventory, and also your typical normal purchase process, because this is a bit different. In addition to everything you have learned, there are more things to be learned on this PPE. So these items are critical for PPE. This is what we want to look at now, and I'll break it down into 3 stages, which is about the first thing is you have to buy the PPE. Once you buy the PPE, definitely you will recognize. Then the next thing is subsequent measurement, which is when you will depreciate. So you have to depreciate it. And remember, I-16 allows you to do 2 models. So either you are doing a cost model or valuation model. If you are doing a cost model, you do depreciation. However, you can choose to do the valuation model, which means instead of depreciating, you'll be doing revaluation. And once all of that is going on, you also need to keep the assets and use it. So I'm going to look at it in these 3 dimensions. The purchase part. Remember what I said. You need to still understand and leverage on your understanding of the purchase cycle. But there are few things that are unique to PPE, and that is what I'm going to cover on each of these processes that I've drawn here. Now, so we can now go back to our standard table, which is what we've been using, which is know the process, know what can go wrong, which is the risk, then what will be our control objective, then which control will help us achieve the objective, then how will auditors test the control. So standard, this is what we've been using, and I'm sure by now you must be super used to it, because with this you are fully covered. Okay, so the first process we'll look at is the purchase. Buying the PPE itself, the non-current asset. You have to purchase it. And what can go wrong? The first thing is that a car is bought, but the car is not for business. Remember, we did it in the purchase process, so I'm not going to cover it here again. So I'm just going to talk through it. So during the purchase, you can buy an asset that is not for business. So the control objective is to ensure that the asset is bought for business objective, and the control in place is to ensure that the necessary approval is in place by the director and the management. And likewise, auditors will test that by making sure that there is an approval document in place for that purchase. So I'm not talking about that. But still on that purchase, the biggest thing for PPE that can now go wrong is the wrong accounting. Because remember, you capitalize non-current assets and you don't expense it. So this could be recorded in an expense instead of capital, or what is recorded in capital account is for expense. So that's why I'm bringing it out very clearly here. Wrong accounting is what could go wrong. And our control objectives ensure that only assets of capital nature is recorded in non-current asset account. Remember, I-16 mentions those criteria. Before an asset can qualify as a non-current asset, it must be able to generate future economic benefit over 1 year. That's very important. It is also tangible, because we are looking at tangible non-current asset here. Yeah. And likewise, the cost has to be measurable and all of that. So those criteria must be met before you can capitalize an asset. Yeah. And what will be the control activity for this one? There has to be an approval by someone knowledgeable, by a senior person. So approval of the posting, which is the capitalization of the assets. So approval of the accounting entries by manager. Yeah, and auditors need to request for the approval. Request for approval for items capitalized. So that's how auditor will check for that. So that is very critical for you to note, because I know we didn't cover this under procurement, so I had to bring it because this is PPE, so this is specific to PPE. Now this is that. Now let's look at the depreciation and revaluation. So while you are doing depreciation, what could go wrong? I'm sure you will know that you are prone to error. So error in calculation of depreciation. So you can make mistake. Yeah, and our control objective is to ensure that depreciation is accurately computed. Depreciation is accurately computed. That is our objective. And the best way to achieve this objective is to automate the depreciation process. Let the computer do the calculation. Automate depreciation process. Yeah, that is one. And beyond that as well, you can have a regular review. That helps. Yeah. Regular review, because sometimes the amount is correct, but the basis is not also correct. So you automate. So you do regular review of, you can do month to month. So month on month, to see why is your depreciation figure should be the same every month, except there's an addition or asset that has been fully depreciated. So when it is different, you will now need to investigate whether it's based on new additions or based on something that has been fully depreciated. But that regular review of month to month depreciation will also help, and because this will help you detect if there's a bug in the system. And likewise, the basis of depreciation needs to be reviewed. Yeah, and I'm going to get to that. But for the amount itself, remember, we are talking about the amount here. So the amount can be wrong, right? So automate the process and review regularly. Yeah. So when auditors are testing this, they just need to check for evidence of review. Yeah. For automation, you just need to test one transaction to be sure that the system is doing the right thing. For system accuracy. Yeah. So that will take care of error in calculation. However, another thing that can go wrong is that the depreciation policy that we are using is not appropriate for the asset. I've audited a company that decides to depreciate their own vehicles for 15 years. And you wonder, who does that? This is a commercial vehicle. The standard in the industry is usually 4 to 5 years. Why are you using 15 years? So, inappropriate depreciation policy. Inappropriate depreciation policy. That's another thing that can go wrong. And our objective is to ensure that depreciation policy is appropriate. And how do we set up a control that will achieve that? We need to regularly review our depreciation policy in line with the industry. So regular review. Very important. Because without that, we will not know that what we are doing is wrong. So regular review of depreciation policy. Yeah, in line with industry practice. Very important. In line with industry practice, we need to do that review. And when auditors come as well, that's a similar thing they will do. Auditor needs to compare depreciation policy with the peers in the industry, just to make sure that the client is not doing something different from what is happening in the industry. Very important. Yeah, and remember, if you decide not to use the cost model in IAS 16, which means you want to do revaluation, because it depends on the question you have in front of you. They might give you a question where a client is doing revaluation. They might give you a question where a client is doing cost model, which is depreciation. So you need to know as well. And this is about determining the value of the asset every year. What could go wrong? What could go wrong is that the wrong value is attached to the asset. An asset that is worth 30 million, they put 35 million, 40 million, 60 million. That's overvaluation, which is most likely the risk, right? So the control objective is to ensure that the valuation reflects the recoverable value or recoverable amounts of the non-current asset. Yeah, so it should reflect the recoverable amount from the non-current asset. And what will be your control? So you have to use an experienced and qualified, valuer. Very important, which is the same thing auditors will check. So when auditors come, they need to check that valuation has been done by a qualified company. That's what auditors will check when they come. They will assess the valuer to be sure that they have experience and they are very qualified. Okay, now keep and use. This is the part that is very similar to what you will see in inventory. Yeah, and because you always have to keep your assets same way you are keeping your inventory, and what could go wrong while you are trying to keep it is similar. And the risk is that assets can be stolen or damaged. That is a risk. Yeah, and here you want to prevent that as much as possible. So you need a very strong control, and you see a lot of controls that we have to design in this place, right? So our objective is to prevent all of that. So here we want to ensure asset is not stolen, it means it's safe, or damaged. And what controls do we need to do? I'm going to talk about 4 solid controls here, which you must know. Extremely important for non-current asset. Please pay attention. The first one is to ensure that All assets must be tagged. So all non-current assets must be tagged. Tagging them means giving them a name. The same way you have a name. Everybody has a name. So when you go to a class, you say, give me the list of all the people in this class. Yeah, because they have names. So you first and foremost ensure that all assets are tagged. The another control is to now ensure that you maintain what we call asset register. Maintain an up-to-date. So once you buy an asset, you register it in this register. It's different from your GL. So register is outside the GL. You have your register and you have a GL separate. So you buy an asset, you write it down in your register, at the same time you post it into the GL. Right. So you have two records that you are keeping. At the same time, if you sell the asset, you take it out of the asset register and you also take it out of the GL. So asset register is very important. Another control for this is to perform periodic physical asset verification. This is similar to stock count. In fact, it's synonymous to stock count. The same way you do stock count, for non-current asset, we call it physical asset verification. The same way you go there, you have your asset register, you are checking from your asset register, I have car with registration number X356 on this register. Where is the car? You go and look for it on the floor. You saw, oh, I can see it. You pick another asset with the tag. I saw a computer with tag number X372. Where is this computer? You go and look for it on the table. Oh, I can see it. There's a tag behind it, X3. So that is physical asset verification. Because if you see asset on the register, you can't find it in the office. Then that means it's stolen. Right? So very important. It helps. It's a good control. And above all, the fourth one is to now ensure that you perform a periodic reconciliation between the asset register and GL. Very important, because your asset register must be equals to GL. If the value of the asset register is 25 million, the GL should also say 25 million. So that reconciliation is very important. So when auditors come, they are checking for the tags. So auditors will select samples of assets and check that they are tagged. And usually all of these will happen during a process, which is auditors also trying to perform this process. Also, auditors should also perform their own physical asset verification. And what do? They will collect the asset register. They will select sample from asset register. They will look for the real physical assets. Likewise, they go to the client side. They select some samples of physical assets in the office, and they say, show me on this register, just to be sure that the information on the register is the same thing as the information in the office as per the physical asset. Very important. Yeah. And lastly, they should also obtain evidence that even clients are doing their own reconciliation. So obtain evidence of reconciliation. Remember, auditors cannot do as much work as client who is at work every day. So, but auditors can rely on some of these controls if the client is operating them effectively. So they need to obtain evidence of reconciliation between the GL and the asset register. Very important. So once auditors are able to do all of this, they will be good that non-current asset has been recorded at the right amount, that it is not damaged, because they've done physical verification, they've seen the state of the asset, that the asset is good. It's not like you are recording a car on your GL, and by the time auditors goes for physical asset verification, they could see that that car does not even have any tire. The engine is not working. That means that particular asset is damaged and is not adding any value to the company. That will be it for non-current assets, and next video we'll finish internal control with the last process, which is cash and bank.